What if there was a way that you could turn your bad debt into good debt and effectively pay off your home even faster? In this video, I'm going to share with you a concept called debt recycling. I'm going to break it down, simplify it, and show you exactly how you can do it to then grow your multi-million dollar portfolio. If you guys are interested in what my thoughts are, definitely keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, personal development, and all things financial freedom. Now, if you do need help in scaling up a portfolio, buying multiple properties in a market that is so difficult to buy in right now, then definitely go ahead to our website, searchproperty.com.au. We have a team of over 40 staff, now edging towards 50, and the reason we have such a big team is because a lot of you guys need the help and you're reaching out. So what we want to do is double down on what works, help you guys get the support, and also double down on being ahead of the market so we can use our data and our research to be in markets before they become a hotspot. Now I'm going to dive into my whiteboard here in a second and I'm going to show you exactly what the difference is between good debt and bad debt and how today you can take advantage of this, especially if you have your own home. Now, most people that have their own home have debt attached to it. And unfortunately, right now, with how the tax laws are here in Australia, you can't claim a deduction against the repayments you make. Now, if that makes no sense at all, smash that like button. It gives me extra energy as you press it, and we'll go straight into it. Now, I mentioned good debt and I've mentioned bad debt. Now, the easiest way to understand this is that good debt is income producing, whereas bad debt is the opposite, which is not income producing and sometimes takes money out of your pocket. So if you're attaching good debt to good assets, it should be income producing, and that would be something like an investment property. It'd be taking out debt to go buy shares. And then bad debt is having your own property because you can't claim against it and it doesn't produce an income. If you go by Robert Kiyosaki's definition of what an asset and liability is, he would go on to say that your home is a liability. I've said it on this channel before as well that I agree with that to a certain extent, because a liability would take money out of your pocket. Now, if you hold a property that you live in, it's taking money out of your pocket. It's not income producing. However, you can go and take the equity from your property to go and purchase multiple properties. So it's gaining equity, it's gaining capital growth. So technically it would be an asset. Now, by that definition, if you think it's an asset and you want to know how to build a portfolio with equity, so put no money down, definitely go check out this video. I break it all down for you so you can bookmark it and come back to it. Now, most people would have their actual home loan structured like this, where they put a portion of cash towards the purchase of their home. Sometimes it could be 5%, sometimes could be 25%, and then the rest of it would be debt. Now, the reason why this is in red is because debt is apparently really bad. Now, technically in this case, it is bad, but we're going to try and turn the bad into good. And the reason why it's called bad debt is because there are no tax deductions. Now, when you get into an investment property, you can see that the debt is actually in green here and it's not in red. And I'm going to come back to that in a second. Now, again, you could use equity or you could use cash to go and purchase this property. But the reason it's good debt is because you can claim tax deductions against the expenses. Now, I've mentioned it a few times. So what does it actually mean? Well, let's look at this assumption here. Well, before I get into the deductions, I'm going to show you an assumption that we can make before we get into the nitty-gritty. So let's assume that our home has $500K worth of debt. Now, at a 6.5% interest rate, that would mean about $32,000 is coming out of your pocket that goes towards the repayments. At the end of the year, there are no deductions. So if your income is 100K, the tax that you're going to pay is based on your salary of 100K, okay? Now, when you look at an investment property, let's assume the same numbers of 500K and 6.5% as an interest rate. That means $32,500 towards the interest repayments. Now, in this case, if your salary is, again, $100,000, because you have a deduction of $32,000 here, it would effectively mean that the ATO is going to now assess your income at $67,500 instead of the $100,000. This is very important because in Australia, as you know, there's tax brackets and you could suddenly fall from one tax bracket into the other and it could dramatically change how much money you're left with at the end of the year. Now, you've got to keep in mind, you've got to add back the rent and you've also got to subtract other costs. So this number here of $32,000 is just your interest repayments. You also have council rates, water rates, property management fees, insurances, and maybe some maintenance as well. That would then go and add into this number here, which means further reducing your taxable income. Now, yes, you've got rent that comes in. If you've got positive cash flow, then it's actually going to add to your income and you will pay slightly higher in taxes. But for most people right now, in the first couple of years of owning a property, you're probably going to get the benefits of negative gearing, although that is a hotly contested argument as to whether it's going to stay or whether it's going to get cancelled. You should check out this video. I share all of my thoughts around the tax changes that could be coming and affecting you, even if you are a renter, because it will affect you. Now, in this case, we know that we've got the good debt and we've got the bad debt. So what's the solution? Because right now I have a home, I have equity in it, I have put my cash towards it, but I have debt. I want to make that debt start giving me some deductions, and there is a way. Now, the solution is that you could use the equity from your home to go and purchase an investment property, okay? Now, the equity here is now tax deductible, which is very important. So I'm going to break down how this actually works. Now, we know that the home debt that you have here, which is here, is actually not tax deductible. The home equity, as it currently stands, is not tax deductible. There's no debt attached to it. But if we now use this as equity to go and purchase our investment property, it is now tax deductible. So if we use $100,000 from our equity in our own home, we would be then paying about $6,500 on the interest repayments. But more importantly, it is the difference between owning one house by itself, which is what you live in, to then going and being able to purchase an investment property. Although this concentrates on just the deductions and, oh my God, okay, I get a bit of tax back, you've got to focus on what that means for your wealth building opportunity. We've got so many clients that we've helped where they've held their own house for a couple of years, it's got some equity, but it just sits there. They have no other investment properties and don't know how to move from one property to 5 or 6 properties. They've gone and used the equity to then purchase multiple properties. That's how you go and create large wealth and generational wealth. So in this case, yes, you get the benefit of the $6,500. That would offset your taxes. But now, because you have an investment property, you're probably taking out another $500K worth of debt. And that's that big D word that you absolutely hate. In some cases, you love the D word, but not in this case. And in this case, that would still be tax deductible because again, you're using it for productive assets. So the next step here is to go, okay, Ravi, I've understood that I can use the equity in my home and then I take out that and then I can purchase an investment property. Whoop-de-doo. Well, that's level 1, my friend. Level 2 and level 3 is what I'm about to explain now. What you can do is use the equity from your home and go and purchase multiple investment properties. Now, why you would do this is because all of these properties at some point will generate an income. It'll generate an income, especially if you go interest only, and this is why we have this strategy. Because what you want to do is you want to keep productive debt. You want to get rid of non-productive debt. And this is why if you went interest only, interest only, interest only, but you went interest plus principal here, it means all the surplus cash that you generate from here will go straight into paying off the non-tax deductible debt. That's exactly what you want. So what you do is you get the rent here, that goes straight into paying off this debt here, which then thereby creates more equity, and that equity can then be repeated to go and purchase investment 4, investment 5, investment 6. So what you're doing is you're paying off the debt, which is against your own home, therefore getting to a position where you only hold good debt. And this strategy is used to pay off your home even faster. Now, if you are interested in knowing how you can pay off a 30-year loan in 10 years' time, definitely let me know in the comments down below. Everyone hates debt at this point. If you can use debt in the right way, it's fantastic. If you're not using it in the right way, you're probably just focused on saying, how do I pay this debt down? I can make a video for you. Just comment down below, pay off debt faster, and I'll make that video for you guys as well. The idea for this video actually came from comments that you guys put in previous videos. So yes, I do read the comments, and most of you guys are really nice. Some of you guys aren't so nice, and I hope the pain that you're going through, you overcome, because this is a fantastic space to be in. You're building wealth, and I understand not everyone can do it, but at least if you have an abundance mindset, you have a growth mindset, you're gonna be able to take the nuggets of gold, so when you are ready, you can go and execute. So just to recap everything that we've spoken about, so it makes a lot of sense, is that our home has debt in it, and that is okay. But we also have equity. We can use that equity to go and purchase investment properties, and thereby the equity that we take from our home is now turned into tax deductible debt. That means we can claim against it. And when we do that, then we have the opportunity to just rinse and repeat. What you'll find yourself doing is in 10 to 20 years, you'll have the investment properties grow so much, you can eventually sell a couple of those and pay down all of your debt against your own home, then go and refinance your home, take out that money and go and buy more investment properties if you wish to go and do it that way. Again, you've got transaction costs and things like that. But again, your focus is not reducing your taxes, it's about gaining wealth. You build wealth in the right way, you can also reduce your taxes as well. That's why I make videos here every single week. I'm here 3 times a week. And yes, when I'm not here, my full-time job is running Search Property, the buyer's agency, which is one of the leading buyer's agencies in all of Australia. So if you need that help and you want to move at speed, you definitely want to contact us and we can get you started. I hope you guys have enjoyed this video. If you have, smash that like button, subscribe if you haven't already, and I'll catch you guys in the next one. Thanks, guys.